Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host, Smart Property Investment Show. Hope you're going well. I'm probably sick of welcoming everyone back to 2022. We've been sort of at it now for about a month. So we're smack bang in the year. Things are happening. Lots going on. We're covering it at length on the Smart Property Investment Show and also smartpropertyinvestment.com.au, where you can get your daily dose of everything that you need to know around property and investing in property in Australia. If you're not going to smartpropertyinvestment.com.au, you're not going to be as good an investor as what you can do. So go and check it out. If you haven't done it beforehand, go there. Every single day, there's something that will probably help you frame, shape, give you some interpretation of, or challenge some of your ideas around investing in property. And the reason why we do that is to help you out as a property investor, so you buy the right stuff or sell the right stuff and doing property investing at the right time. Investor stories, big key thrust of what we do, both on the Smart Property Investment Show, but also smartpropertyinvestment.com.au. You can click on the button, you can read all the investor stories that we have. A lot of them come out of this particular podcast, where I bring people in from right across Australia to have a chat about investing in property. Some of them have one or two properties. Some of them have 31 properties. And today's chat is that particular person. You would have heard is awfully cryptic the last time this guy came on the podcast. Didn't give us a lot of information. Sam Gordon, Australian property scout, property investor first, and we'll get into it today. Bought a lot of properties while he had a different job. Loved property so much he decided to make it his career, and we've sort of spoken to him about that and the type of work he's doing at Australian Property Scout. But today he's here to talk about his own investing journey. He set himself a goal, he tells me, when he was a young spring chicken, to have 30 properties by 30, which he didn't achieve. Negative property investor, but he did get 31 properties by 31. So you fast forward a year, no doubt you're going to blame COVID. What's going on, Sam?
G'day, Phil. How are you, mate?
I'm good.
That's good. That's good. Yeah, man. So I had from very early age there, I had the old 30 by 30 goal. I thought it'd be pretty cool. Well, initially I wanted to buy 20 properties in my 20s. I did that. And then I was going for the 30 by 30. You're right, mate. I'll throw COVID under the bus a little with this one. I had a block of dirt that in the middle of COVID, I had to settle. It was like mid of that 2020. And I had to pull together about 300 grand worth of cash. And that kind of tapped me out of that accumulation process that I'd kind of planned and strategized for, where I thought I was only going to have to put in about 60 grand. I ended up having to put in about 300. So
did it undervalue, did it, or you couldn't get the finance, or what happened?
Yeah. All my funding got cut. So I had it lined up.
You had to pay cash money for it?
Yeah. I literally had all these like equity releases that I'd done before I left my old job, as I was going full time into the buyer's agent space and running it pretty solidly through there. I couldn't get bank funding because I was sole trade. Whatever it was at the time.
Yeah, you're just new to business and they get a bit jippy around that.
Yeah, they love those. They love those 2 full years of financials. And I'd been running a sole trader before, but then when I'd converted to corporation, I wasn't within that time frame. And like I would have been okay with the way the policies were before COVID, but then when COVID came in, a lot of the banks, it was just going to be like a second or a third tier lender that would lend me, 75% or something. And then all these changes came in especially on vacant land, because there's no income being produced from it. You can't live in it unless you want to pitch a tent. You might do that. I don't know, mate. But
I'd
you
be
can't.
Happy. Put my swag down. I'll be right.
Yeah, the old swag goes all right.
Yeah.
But yeah, they cut all lending on vacant land, so I had to settle on it with cash. So yeah, all that money that I'd had for accumulation for additional purchases, unfortunately, got stripped.
I can hear all the other Australians who are 30 years old going, "Oh, poor old Sam couldn't buy his 30th property by 30. Poor bloke. He's been hard done by."
No, definitely not crying poor, man. That was why I missed it. And that's why I was like, look, I missed it. I had to do what I had to do. I did really well out of that deal in the end. It was a nice little development site that I had that I thought I was going to make a certain amount. COVID kind of had a funny way of shafting me my 30 by 30, but I had about another 500 grand's worth of growth on top of that deal. So I'm not complaining too much.
Yeah, beggars can't be choosers, mate. So you got 30 31 by 31. And I joke, mate, like you should be congratulated on building out that portfolio in that speed of time, mate. Like it's impressive. It goes to show to, I guess, your peer group. You know, you're a decade younger than me, or you're a decade probably before me. And to do that by that age, you've done something right. A lot of people think you've done something wrong, and that would probably be reckoning affordability for every other Australian. But this is a podcast for property investors, so we think that's okay.
Yeah, that's good.
So you've done something there, mate, to actually make that happen. And I think it's testament to the fact that you're still a young guy and you've created this asset now. We'll sort of break down what that looks like. And you've done it despite all of those challenges that millennials, you're a millennial, Gen Y's have, right? Yeah, so it can be done, but it's how it's done. And no doubt for you, a bit of that's been the goal setting part of it. That's probably a good place for us to start. Like 30 by 30 or 31 by 31. Look, it's a bit of vanity, you know, it's a nice sort
Definitely is, man.
Yeah, but it gives you something, right? You go, okay, well, yeah, it's something. So when did you start sort of thinking of like longer term goal setting when you started your property journey? Was it at property number one? Did you go,
nah,
Sam Gordon, I'm going to do this? Or just
mogul.
like, I'm just going to start buying property.
Nah, it definitely wasn't, man. So like I did my first one, it was a good deal in terms of what it was. But like, if I look back now as like, it was not the right deal to start with, like start your portfolio with. It was too negative cash flow for someone on my sort of income. My kind of goals and what I wanted to do really changed as I grew. I always wanted to build a big portfolio. Always knew that a lot of people with a lot of wealth typically either had it in or had made it through property. So I always knew I wanted to do a lot with property, but I had no real idea. I think when I started out, the initial goal was 10 by 30. 10 properties by 30, I thought would have been a great little thing to be able to achieve. I think I hit 10 at 25 or 26 or something. It was somewhere around that sort of thing. But I bought the first one at 19 and then was able to pull equity and do it. I did a little small, it was just like a house, and I went and sourced land and then built. We spoke about this a while ago when I was 22, and then pulled equity from that. And just kind of learned as I went through the way you could kind of build it and scale it. And then I started doing 2 a year. And this is what I always say to a lot of my young clients that come to me maybe with like 50 or 60 grand. And these really ambitious goals really soon. I said, it's like an age old thing. Like you overestimate what you can do in a year, but massively underestimate what you can do in 10. And essentially, like I built pretty much the whole portfolio in about 11 or 12 years. There was a lot of sacrifice in there in the middle of it, well, through the whole thing of it really, but it's that snowball effect that starts coming through. And this is what I tell them all. It's like, we'll put that deposit to work and we'll try and get ourselves 2 properties off the back of that in the first year, try and replicate again in the second year. And then as you start going to the third year, it really just starts to snowball. And that's exactly what happened with me. And that's what I experienced. And then when I realized, like, I was like, shit, like I pretty quickly went up and hit the 10, and the portfolio had some really good growth. I had some good properties in Sydney. They performed really well for me. And then I was pulling big chunks, a couple $100 grand at a time out of these deals, and then really leveling up the game. And that's where I decided really, I set the goal of 20 in my 20s. I hit that just before, while I was still 29. And then that's where I was going for that really aggressive, stripped everything out of the portfolio, leverage right up, went for the 30 by 30, but missed.
Yeah. And what you're talking about there is this adage of you got to crawl before you can walk. And to build a portfolio, 5+ properties, let alone 10, 20 or 30 properties, you just got to do for the first few without, like, I think it's okay to think, okay, well, to your point, you made the observation that looking at wealthy people, they either made it because of property or they have property. So you can't just instantly become that person. So you got to do the doing first. And that's sort of the first property is absolutely critical. You got to get the first one right, because that gets you into the second property. Most people stop at 2. I can't remember the stats. 80% call it of all property investors have 1 or 2 properties, because they either buy the wrong stuff to start with, or they just have that capacity, the mindset, the ability to move beyond 2. So you got to get those first 2 done, and you just got to concentrate on that. It's only when you get that you can start thinking about what the future looks like. What does 5 look like? What does 10 look like? What's 20 look like? What's 30 look like? And for you, is 31 is that enough, mate? Like, do you need any more property?
For what I want to do, like for what I want to hit, like, yes, I guess I haven't even really reset the bar yet since I hit it. Because
it's going to be for 40 or 440, is it?
I don't know, man. I honestly don't know. I think I'm gonna consolidate a couple of my Sydney ones that have kind of been through that second boom, and then reassess what I go for next. But it was like we were talking about offline before we jumped on this, maybe going some projects that maybe that little bit bigger now, because I've got the key to it, right? And you know this as well. This is literally what we were talking about. The key to it is building the foundations. And a lot of time you've got to build the foundations in a lower price pointed sort of area and in a more affordable bracket, because it's very hard to build a portfolio of 31 properties at $1 million each.
Yeah.
But building them, around $400,000 or $500,000 each or something like that, you have much better cash flows. A lot of the time your growth percentages are the same or more. You have some exceptional growth, and that allows you to kind of re-leverage. One, you got the better serviceability, but for two, you're still getting that growth and still able to strip that out. And it's a funny thing too, man, because you think about it's getting a 10% discount on a 400 grand or 500 grand property, right? You're talking 40, 50 grand, or let's say making a 40 grand discount on the way into a property is awesome. But when you go to $1 million property, the deposit amount you need to get into something like that, right? We're talking even a 10% deposit, talking well over 100 grand with stamps and everything. So it's a lot harder to re-leverage yourself back into another deal when you're going so expensive. Whereas when you're going smaller, you're almost making your deposit on the way. If you're buying well enough, you're making your deposit on the way in. You only need to chip in a few extra things to get by. So you can just build it and replicate it a lot quicker. And I think that's where a lot of people go wrong. They think, I need to buy something I would love to live in. If we're talking Sydney, Melbourne, even bloody Brizzy now, we're not far off $1 million.
Yeah, it's starting small in that affordable bracket is a strategy that has served many property investors well. And if you go and look at those property investors who have been at it for a little while, or they've got sizable portfolios, whether a number of properties or the value of them, you will find some clues in there. And most of them will have sort of operated initially in those affordable areas to build a foundation of portfolio that will propel and project them into other things into the future. And that might be higher value type of properties, or mixed use type properties, or multiple asset type properties like apartment blocks. But then you'll see, they'll move into starting to tinker and tweak things around developing and all that sort of stuff. So that's a journey most successful property investors go through. And you've got to embrace that sort of stuff to get going with property and start driving forward with property. So that's the way it is. And it sounds like that's what's worked for you, Sam. I want to get a sense for your portfolio.
Yeah.
Let's go to break beforehand. Back in a moment.
Looking for a blue chip Gold Coast investment property, or trying to relocate to the beautiful sunny Gold Coast but keep missing out on the right properties? Maybe you need an expert on the ground to source the right property for you. The Srama Group are the leading recommended buyers agency specific to the Gold Coast, providing their clients with exclusive off-market property opportunities, specific insights into market, combined with a large network of dedicated professionals to ensure you make the right decision without the hassle. Get in touch with us at thesramagroup.com.au and secure your financial freedom today.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Sam Gordon. He's director over at Australian Property Scout. We're chatting through his own portfolio and how he's gone about building 31 properties by 31. And we'll sort of get some planning for him moving forward. But 31 properties, Sam, it's a lot. I'm just trying to think the best way for us to go through them. What's the total value of your portfolio now?
Just shy of 15 million. I was working out the other day.
15 million bucks.
Yeah.
Okay. How much debt have you got?
8.5.
Okay. All right. That's not bad. So you reckon you clear about 6 million bucks in equity?
Yeah.
Okay. Does that make you a millionaire?
It's all tied up in property, man.
You're down shouting rum and cokes at Gold Coast RSL, mate. They go, there's Sammy Gordon, the $6 million man.
Hey, I'm still the biggest tight ass there is out there, man. My missus loves it. Okay,
mate,
I'm still looking for sales, man.
Yeah, my wife has the same issue with me, though. I still only buy stuff that's on spec.
Yeah, 100%.
Yeah,
I think that's the thing about, man, when it's in you, it's just in you, right? If you love a discount, it doesn't matter whether it's property, a car, buddy, peanut butter at this, Woolies or whatever. It doesn't matter, man.
I can't buy anything without getting discounts.
Yeah, same.
But it's funny. People that know me will go, I've always been like that. Even at high school. I was always haggling teachers for more marks, and I was always just trying to get I used to have brackets at the canteen stuff, where I used to get stuff cheaper than everyone else, just by asking for discounts back then. Yeah. So I think it's one of those things that's in your blood, mate. 6 million bucks equity, that's good going, mate.
Thank you, man.
So sort of LVR, you're sort of, what's that? You're about 60-ish.
Around about 60-ish, yeah.
60%. And LVR, for those that aren't familiar with that term, it's the loan to value ratio. So it means that what is for every dollar of debt, how many dollars of equity have you got, is a simple way to put it. And for Sam, for every $10 or $100 of every $100 of equity, he's got $60 of debt. So he's got $40 there.
There you go.
Yeah, there you go. It's an easy way to look at it. Trying to just break down the maths. So, but to be fair though, an LVR there's two ways to look at your journey through property. It's your age, but then also the maturation of the portfolio. And the thing in your benefit is that you started really young doing it. So you pretty much accelerated probably your property buying journey, I would argue, by 15 to 20 years. So when you look at when most people start thinking seriously about property investing, it's normally in their late 30s to early 40s where they've got their job, they might have got some kids and stuff, they've got a family home, and they start thinking about, oh, I'm not going to live forever. I've probably got to start thinking about what life looks like when I'm not working anymore. Let me have a look at property investing. So they get a window of maybe 3 market cycles if you start investing in your late 30s. What you've done, because you've kicked off in your late teens, 19, were you?
Yeah, 19.
You've pretty much given yourself a 20-year head start on pretty much everyone else. And that, mate, is a huge enabler. So it just goes to show starting early. So you've been out a long time. So you're sort of, you would argue you've got a mature portfolio. You're in the middle bit of your portfolio in property investing journey rather than at the start of it. So, but then you're young as well, which changes things up. So
it gives you the option to retire a lot earlier than I guess the averages.
Yeah. But a lot of people would say he's got 6% LVR. He's only 31. There's a lot of lazy money there. It's not working for him. He could and should be going harder, is what some people would say. Other people would say 60% LVR, 31 properties. This guy doesn't need to do anything now. Like, you can just sit there and wait one market cycle. That LVR position is going to change absolutely ridiculously. You wait 2 market cycles, it's going to be down or whatever. And then you probably just need to sell a couple of properties in 2 cycles time, and then you're going to be debt free.
Yeah, it's true, mate. Look, I think the thing with mine, I normally accumulate at 80% lens, right? So I'll buy at 80%. I'll chuck 20% deposits in. I've always bought, not always, sorry. Like my first 7 deals were all between 90s and 95s. I leveraged pretty hard back then when I first started. But then, these days, man, and I've been doing it for a long time now, is 80% lens. So like that extra 20% fat in there is really just the growth we've really experienced in the last 12 to 18 months. Like a huge chunk of that's been in there. But obviously I've still been accumulating pretty hard. So that's where the balance is. Before I was accumulating really hard again, I was probably still sitting around that 60, but then the extra growth, but the extra buys have kind of brought it back into the middle again. So yeah, man, it's been a pretty good journey. And mate, I'm definitely happy. Portfolio that size with LVR at that as well. It's been good, man. It's funny. It's like I've got a nature to go hard, but I still love to be a bit conservative. Like I love to have a lowish LVR as well. So I've always, shit in the world hit the fan. Like I could still quite easily maintain, or it'd still be paying me quite a good salary having that portfolio as well.
What's the cash position on that portfolio? Is it positive?
The cash flow?
Yeah.
Yeah, she's positive, man.
Yeah. So what is his portfolio after everything?
Yeah.
All said and done.
Yeah.
Pre-tax. What does it put in your back pocket?
Pre-tax, before depreciation, before paying anything, all the rest, it's over 300.
Okay.
A lot of what I do, I built the foundations with a lot of growth and recycling equity and everything, but then I turned a lot towards cash flow. So cash flow still in high growth areas, man. It's like all the cash flow deals that I did 18 months ago, cash flow specific deals, but in growth locations. I've seen over 200 grand growth on those deals. And so like, I think it's a bit of a fallacy that you can't get the growth as well as the cash flow. But when I got to a very advanced point in my portfolio of equity growth, that's when I started building in some really strong cash flow deals as well. Because I knew for one, I needed the buffer, but I also knew for two, like if I ever wanted to pull the pin or if I was done with it. And I mean, this is what I did with the old job, really. I wanted to replicate that and replace that income, which is I didn't fully do it before I left work, but I got pretty close. And then, man, it's just been pretty much a continual accumulation of those solid deals as well recently.
So you could stop now and put 300 grand in your back pocket every year. Doing nothing except,
and that's at a 60% LVR. So you drop 60%
LVR. Yeah.
Like it's obviously increases. It was going to be increasing over time as well as a consolidate a few things.
What do you do with that money? Do you sort of separate the stuff and you go, you got your business over here and you got your property over here? That money just stays in a property portfolio. Like, are you just building it up to?
I just reinvest it, man.
To put in more property.
At the moment, I just reinvest it. So I honestly reckon this is where a lot of people ask, like, how do you? It's ludicrous. It seems a bit ludicrous, that number, but man, I've never taken the profits, the amount of things I could buy with what I have within the portfolio is stupid, right? Like the imagination can run wild and you can pretty much buy it. But like the reason I've gotten to where I've gotten in the portfolio I've built is because everything on the side that I earned when I was growing up and as I was building this out, everything went back into the portfolio, the cash flow, the equity. And now I am at a position where, if I wanted to, I could just walk away and that cash flow is there for life if I really wanted to. I won't because I love what I do. But yeah, man, that's pretty much how it's been. It's just been that continual reinvestment back into the portfolio has really been what's, into the cash flow and the equity has been really what's allowed it to grow to the size it is.
Yeah. Speaking of property investors with large portfolios, you ask most of them, well, you don't need to do any more. Just stop. And they go, yeah, I don't want
to. you don't get to that unless you're driven, man. You don't just retire at 30 because you hit a goal. Like, what are you going to do?
Yeah. You'll still be dabbling when you're 80, right? Like still trading property or buying or selling and stuff.
I reckon so.
Yeah, which is cool if that's what you want to do. It's a lot of people, and I'll probably subscribe to this somewhat. I rather the game than the outcome of the game. The outcome of the game is wealth, which largely means choice, and that's all cool. But if that's your driving factor, often you sort of miss a lot out of it as well. So if you actually enjoy the idea of winning as in doing the job well, as in buying property well, with an eye towards the outcome. That's how I'm wired as a property investor. I don't really sit there and get a calculator out and sort of crunch numbers and stuff. I like to know that I've done something well. Either I've got something, I've bought something well, whether it's huge upside opportunities or you make your money on the way and stuff. That is the good bit, right? That is a good bit about property. That's the endorphin part of because what happens is the outcome becomes really normalized. We just go, it's just whatever,
good deal,
right? And you might sort of get an uplift for a little while, and then you just go, well, it becomes normalized, and everything resets based on that normal level. When you speak to most people who create wealth through property, things just become normalized, and there might be a difference for a month, but then it just becomes normal. It's like a pay rise, right? When most people at work, they go, I've got a pay rise, and you get the first month's pay, and you go, that's great, and then it just becomes normal.
Yeah.
And you go, that's just the way it is. So
it is a funny thing. My missus always takes the piss out of me for it because last year she started her journey back at the start of the year and she actually bought 3 properties in the year. She's probably a good one to get on the way she did it as well. But she laughs because every time she gets so excited. I'm like, yeah, like cool. And then she's like I have settlements come through. I don't talk about them. Like, she's like, oh, that thing settled yesterday. She goes, did you know? I'm like, yeah. And she's like, I eat like so. I'm like, oh, it's a good deal. Like I'm happy, but like it's a good one in the portfolio. Tuck it away. So it's mate, I'm with you. It's funny.
Mate, it is, but you got to celebrate the successes.
Yeah, of course.
Of
course, man.
Yeah, which is cool. So let's have a chat, Sam, around what sort of assets are inside of this. So 15 million buck val, 8.5 million debt, 6 million-ish in equities. That's a 60% LVR. Generating about 300K positive cash a year. That's all cool. So that's top line numbers, but inside of the portfolio to make that happen. We'll just go to another break. Stay with us. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back. Phil Tarrant, host of the Smart Property Investment Show with Sam Gordon. Property investor first, probably buyer's agent second. Is that fair, or is it swapped now?
It's definitely swapped, man. Like I was saying before about like getting settlements and stuff come through. It's cool, but like I get clients like when they ring me and they go, "This is the val we got back," or this deal has been finished and this is what the cash flows are. Man, I get more excitement for them, and it's even like I get way more excitement for like my partner building her portfolio and seeing her do it than I do for my own. So I reckon the property investors probably, it was a forefront phrase. It's probably taken the back seat, and the buyer's agent these days, like I love helping people. Man, like seeing people get those results, it's life-changing, man, what you can help people do.
How do you go about framing it? This is an important point where because you've done so much of it, and a lot of people would look at your portfolio or yourself as someone they would want to emulate,
yep.
But you're sort of back down in the trenches buying $350,000 properties where you might be getting upside of $20,000 or $30,000. And you think, well, in the big scheme of things, if you look at your portfolio, you probably wouldn't notice it that much. But for someone who's just starting off in property and this is the first thing, that's a huge deal, right? It's a huge deal. How do you sort of keep connected with that?
Mate, probably because I still buy properties around that sort of money myself as well. So I still know they're just hugely important. I strategize with each client as to how much they're making, but for two, how much they've got as well. So like it becomes hugely important for them. And I look at everyone as like, and I say to everyone is I want to build out your entire portfolio. You know, I want to be with you at the start. And I want to set out a plan and we tweak the plan as we go along, but I want to be with you at the very end and build that whole thing out. Man, I get very emotionally attached to like the clients and what they're trying to do as well. Because it's crazy, man. It's literally life-changing stuff. So like to me, yeah, $300,000 deal is still massive. Like, you know, for a lot of these guys. And for me, like for me buying a $300,000 property, the reason I'm buying it is probably because there's something wrong with it, right? If I'm buying that and the client's not touching it, it might be like structurally has some big issues. Like I bought two side by side middle of last year. They were both structurally very, very unsound. They were great deals, but I would never give them to a client because for one, it's something that could come back and bite you in the ass, but it's also, they're very, very big projects. One of them was about $100,000 reno. The other one was about 60, 70. They're the sort of things that I still buy those sorts of things as well.
Yeah, and it's good to have that perspective, right? But to your point, for property investors starting out, like it is like the reason why you're doing it is for it to be life-changing. You know, you're thinking about tomorrow and you're sorting it out today. So, you know, that perspective is key. So looking at your portfolio, Sam, what sort of, give us some sort of splits. So 31 properties, it's going to be hard to go through them individually, but ratio of houses versus units or apartments. Yep.
I've only got one unit left. So the first property I ever bought was a unit and I've only bought one other one ever since then. And I don't really touch or buy units. I'm not the biggest fan of them. They always lag from a growth perspective and their cash flows are normally pretty shit as well when you take stride and everything into account. But mate, the first 20 odd, we ran through them together a couple of years ago. Anyone wants to go into in depth as those first 20, we literally punched off like areas and price on every single one and everything. But the split, man, the ratios, I'm pretty heavily invested between 4 states. New South Wales, that's obviously my home state that I grew up in. Got a lot in Sydney and surrounds, got a lot in Brizzy, got a lot in Adelaide. I mean, I did a bit of buying over the past couple of years in Perth as well. So there's a pretty good spread between those 4 states. The bulk of the value is probably spread between Queensland, like Brisbane and New South Wales. When you got a couple in New South Wales or 4 in New South Wales that are worth over $1 million each, it makes up a pretty decent chunk of your portfolio as well. But yeah, then there's a pretty even spread between the others.
The other stuff. And regional rural versus metro?
I bought majority of mine metro. I've always been a big believer in metro. A lot of things have changed with regionals in the last couple of years. So we have done some buying in regionals and I have got some in my own portfolio that are out in the regions as well that did really, really well, like almost doubled in a 2-year sort of window. Bought them very well. So there was obviously equity there to begin with, but then in terms of what I actually purchased them for, went pretty close to doubling in a 2-year window. But the bulk of them are metro. I'm a big believer in metro. I think there's still enough really good metro locations out there with good drivers that it's worth sticking to those.
Yeah, and where you're buying regionally, by memory, I think you're down in Southern Highlands, right? Barrel Way?
Yeah,
got some stuff. Yeah. So, see, those sort of areas, I've sort of been chatting a bit about this on the Smart Property Investment Show lately. I think those sort of areas are going to be really interesting to watch moving forward because they're sort of quasi-metropolitan in that you can get to the city pretty quickly if you need to. So you get everything that attracts people to rural and regional Australia as a place to live or a place to raise a family or a place to run a business or a place whatever.
Yeah.
But you're sort of still tethered to metropolitan locations and for, I guess, Barrel or Mittagong, the Southern Highlands, you're pretty dialed into Sydney. So you're getting people who are attracted to those lifestyle sort of locations because they always have been. But then you've also got to add on top of that the way in which COVID has completely shaped the way we work. You're attracting a whole new cadre of people into those areas who can still get to the city when they need to, or a couple of days a week on the train, or they can be in their car, but they can also work remotely from those locations. So I think they're the sort of rural and regional areas which will buck the trend, I feel, over the coming years. Everyone's sort of talking about sort of more lackluster growth this year versus last year, and then negative growth in 2023. But you got to remember that's sort of a collective of markets. So there's going to be some markets that to continue to outperform other areas. And I think it's probably areas like that,
At 100%.
down that way, we'll do it. And if you go north, the Central Coast hinterland is very similar to Bowral, those sort of areas. I think they'll buck the trends, even sort of out west of Sydney, your Durals or your Kenhurst, that way as well will continue to buck those trends, because it's going to be attracting people to those sort of more rurally, lifestyle-y, acreage type of places. And the same applies in Brizzy, the same applies in Melbourne as well. That's my theory on those sort of locations.
I completely agree, mate. I think a lot of them also stayed a little bit lesser in terms of growth compared to the cities too. So I think they do have a bit more room to grow.
Yep.
Yeah, man. No, I definitely think those lifestyle locations, they got a bit, a bit going for them from that perspective. They're still commutable distance back to the city. But I think it's a funny point you made there about people saying like it's going to be a lackluster year of growth this year and then the markets go back. And the problem is, man, like they're looking at it from a perspective of like all markets are equal, right? But you look at like Sydney and Melbourne, they doubled finishing up, say 2017, most of those markets doubled. And then they went through another massive surge, the past 12 to 18 months. But you look at a lot of those other cities, a lot of them haven't had a decent growth cycle in 10, 12, some of them 15 years. Brizzy hadn't grown properly since 2007, 2008. It was like over a decade of no growth. I don't think it's going to stop at 1 year of really solid growth. I think this year will be another really bumper year for those cities that haven't. It may not be quite as crazy like some of the areas, 30% plus. I don't think it will maybe hit 30% plus, but man, I wouldn't be surprised to see Brizzy, Perth and Adelaide do another 20% this year. It would not surprise me at all for them to clear that. With what I've already seen happening in the market this month, like being back in, first week back in Jan, man, it would not surprise me at all with the way those markets are going.
I think some areas will, and that will probably get an uplift to those areas which won't perform as well. And going back to like, you think about CBD locations now. I don't know if you've been to a CBD lately, mate, but
they're dead.
I think fundamentally they've changed forever now. And sort of, you asked me a year or so ago, I probably would have said, no, they're going to want to bounce back. The governments are highly invested in making sure that the capital cities are hybrid hubs, right? We haven't had tourism, right? That will help when that starts coming back in. That'll fuel part of it. There's a whole bunch of businesses inside these CBDs which have just gone to the wall because there's no one there. And I think maybe it's too much now. The governments, whether state or federal, have a big challenge to try and stimulate CBD growth, but people's attitudes have changed. And I think they've changed now forever. If you think back to 100 years ago, Sam, your areas, and let's talk Sydney, for example, your inner city belts, your inner city rings were where, inverted commas, the poor people lived, because the wealthy didn't want to live there. Yeah. And you think of your Paddingtons or your Surrey Hills or your Newtowns or
Redferns.
Your Petershams or your Redferns or your Alexandrias, that belt, within, people didn't want to live there. So therefore that's where the poorer people, the lower economic, this is where my family's, by the way, because the wealthy people lived out on the fringes, on acreage or in areas where there was less disease, where there was less crime, less problems and stuff, but Paddington, for example, went absolutely berserk in the 80s and 90s because the 2000s, because that's where that was deemed to be where the wealthy people live. So, I don't know if these areas are going to still carry that same sort of appeal moving forward. So that is probably going to put downward pressure on those sort of areas. However, you're going to get upward pressure in those more fringe areas where now the transport links in the city are pretty good. With less people going into the city, they get even better because there's less people on the road. But now there are all these little satellite communities all around each of the capital cities where you can, raise a family. You can have a good life where you're not in the car anymore as much as what you used to be. So these are going to really balance the equation, I think, for price growth. I sort of tend to agree your thoughts on Brizzy. It's been a long time. Everyone's up there waiting for growth, us included. You got the bloody Olympics coming up there. All that's going to be good fuel for economic growth and development, but it's time for Brisbane. So it's good that you're heavy there. You got most of your properties in Brizzy?
Yeah, I think in Brizzy, I was counting out the other day. I think I've got 12 or 13 in Brizzy, across Brizzy, spread right across. So, it's been good, man. It's been good.
So for you then, 31 by 31, what's next? You're going to buy a property a year until you're 50, or what's the game?
Nah, I'm not too sure, mate. I think I'm more focused on building out my clients' portfolios now. That's a real focus of my own now, mate. I'm not too sure personally what I'll do. I don't think, unless those, like I was saying to you, the structurally, stuffed ones come up, I'll still probably buy those things because I don't like seeing a deal go to the wayside if it's a really good deal. But mate, I haven't set a clear kind of goal on what I want to do next. I know I'd love to get into a development. I've always loved small lots and subdivisions, and I want to get into something a bit bigger in those. But yeah, man, in terms of actual numbers, I haven't mapped it out yet. It's gonna be interesting. I'm not one to go small, so I definitely 50 by 50 doesn't float my boat. Yeah, so I don't know what it is. It'll definitely be bigger than that. But
well, you're 31. You're not married yet, are you, mate?
No.
Well, there you go. Maybe you should concentrate on that. You know, you move into another, and if your partner's listening to this, you can.
Phil's got your back.
But but to that point, right? Like it gives you choice. You know, it's much nicer. You know, raising a family if you've sort of largely got your sort of finances sorted out, right? Changes things, you know. So again, that gives you choice, and that's the choice that some people sort of choose. So maybe that's the pathway you want to go, but outside the scope of this particular chat, that's cool, mate. Yeah, it's mate, that's cool. Really good. Really cool. Yeah. Interesting.
I'll tell you what, one thing that pops into my mind, because I've told you this, I think I told you this when we chatted a couple of months ago, but relocated up to the Goldie just before Chrissy, and I'm liking it up here. So I think I'm going to try and find like a knockdown rebuild site on the canal or something like that. So that'll probably be
build a dream home.
Yeah, man. That'll probably be the next.
Get yourself project. A bay line or whatever they're called out the front. You can motor around with your fancy mates up there wearing white shoes. And
we'll see, man. Nah, man, that's not me, man. That's not me at all.
Give it time. It'll be you in a heartbeat. But what's the biggest lemon in your portfolio? Tell me the worst property in your portfolio and why.
Mate, in my opinion, the biggest lemon was the first one that I sold. So the cash flows on it were terrible. Not understanding where I was coming from. Like I paid $275. I was renting for $340 a week, which most people would think would be okay. But there was like $50 a week strata. I didn't know what strata was at the time. Mate, interest rates at the time was 7% back in 2009. So it was a little bit of a different game. I love it when people go, "Oh, it was easy for you back then when you were buying." I was like, "Mate, you're paying like a third of the interest rates that I paid back then. It wasn't easy." And yeah, that was, man, in my opinion, that was probably the biggest lemon because of the cash flow and because I didn't really understand the markets all that well. It was a really good location. It was literally directly behind Crown Street Mall in Wollongong. It was in really, really good spot. But I didn't realize, I didn't know. And looking back now, I look at the turnover of my houses compared to that unit, and that unit turned over even though I was in a really good spot, it attracted a certain type of person, which could be a uni student or something, just different, attracted a different sort of person that was kind of in and out of that area every 6 to 12 months I was releasing.
Transient people, hard work.
Whereas
and that counts up, right? Like if it costs you a week's rent every time you let it out, well, you bleed on it. So on the other side, best property in your portfolio, why?
Mate, I reckon I've got a bunch of really good projects I've put together over the last couple of years in Brizzy, but I reckon probably the best one I've done in terms of like the turnaround. Actually, can I say 2?
Yep.
Okay, so first one would have been the one that I bought at 22. I bought land then and built on that. That was in that one of the first podcasts we did together. I kind of explained the whole journey behind that. But all in, man, that was like $355 that I did the deal for. It doubled in 2017. It would have been worth about $750. Market came back a little bit, and then now that's worth about 1.2 mil. So in less than 10 years, it's tripled.
Where's that? Sorry,
that's down in the Highlands.
Okay,
Barroway, yeah. And that rents for $800 a week. So paid $355 for rent.
That's pretty good. Barrow's a bit fancy, isn't it? I drove through there the other day.
It is. It's changed. I actually haven't lived down there for a few years, but mate, when I was there, she was pretty dead because I was in Mossvale, next one down, so she's a little scummy down in Mossy. But it's changed. It's changed heaps, man. Heaps.
Yeah, I went down to a wedding in Robinson just before Chrissy, and we drove down through. But like looking at the high street compared to other high streets I've been up and down, over the last year, mate, I was struggling to find one place empty for lease there.
Yeah, there's none, man.
It seems to be bucking the trend at least at a high street retail level, which gives you some sense to, it's still attracting some tourists there and the locals also. It's a cool little spot. I like it.
It is. Yeah, it is a good spot, man.
Yeah,
it's a good spot.
It's good. All right, mate. Well, when's your next purchase? Do you know? You're just gonna keep your powder dry and wait to buy something. That's cool. Well, let us know when you do something, mate.
I will, mate. Yeah, I definitely will. Well, mate, it'll probably be the next time we catch up. I'll have reset some goals as well, so I can let you know, and then we can follow them, mate, and see how we go hitting them as well.
Sounds good. All right, nice one. That's Sam Gordon. He's director of Australian Property Scout. Semi-regular guest on the Smart Property Investment Show. People seem to like you as well. I don't know why.
Thanks,
mate. They keep asking to have you back, so I just reluctantly get you on here, mate.
Thanks, mate.
All right, good one. Thanks, Sam.
Thanks, buddy.
Go and check these guys out, Australian Property Scout. Remember, smartpropertyinvestment.com.au. If you keep connected with what's going on, help you make more informed decisions. Website updated all the time. Heaps of data there. Also, our portfolio, you can go and check it out if you want to sort of see how we've gone about building property. Social media, Smart Property HQ is where you'll find us. See you again next time. Until then, bye-bye.
Thanks, Phil.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to refinance your loan for a better rate? Maybe you're considering releasing equity to grow your portfolio or struggling to find a lender that can meet your needs. Finny is the investment finance specialist that has the solution. With access to over 70 lenders, Finny can track down the financing solution you need. We specialize in investment property finance, and we only deal with lenders that have the right solutions for investors just like you. So you're in safe hands. Fast-track your investment strategy today. Visit finny.com.au for more information.